Welcome you to the first FinTech session. As is appropriate for the FinTech session, we have the technology. So if you want to send any questions through to the panel, text them through to 875, we'll get them, we'll be able to run some of them up to the screen. If any of the questions are particularly confusing, it's because the message hasn't been passed on in insurance and wealth, and we're getting their shitty questions as well. So hopefully that won't happen, and the questions will make sense, and they'll be from you guys. So welcome along. I hope you enjoy the session. I'm going to introduce our panel moderator, and then I'm going to get out of here. Darren Stevens here is from Bravura Solutions. Many of you in here will know Bravura Solutions. Some of you are using Talisman, and some of you have moved into the 21st century and are on Sonata. So others of you will know what that means shortly. Darren has been in the industry for about 30 years. He's had some time at ING, some time in Tower, and he's now heading strategy and stuff at Bravura. So that's it from me. I'm going to let the good stuff begin. Darren, over to you.
Thanks, Mark. Good afternoon, ladies and gentlemen. And, firstly, I'd like to say that Bravura are really pleased to be part of this session. We've been providing technology solutions to the wealth management industry, both funds management, superannuation, pensions, and life insurers since the 1990s. And we like to think that we facilitate FinTech, working with existing platforms, but we also create some of the FinTech. So we're very happy to be part of this panel. As Mark said, a number of you are using our software. Over 50% of the KiwiSaver membership is now running on a piece of Bravura software, which most people don't know. We're sort of hidden behind the scenes. We're the intel inside. We have a good story behind us. We've gone from a startup in 2004 to now where we have 1,100 people working in 8 countries. And I'm sure you'll all be pleased to know that our 200 key architects and main development centre is based here in Auckland. I think that's a testament to Kiwi innovation and a can-do attitude, and that's why we do retain that team over here of highly skilled people. Today, I think we're all blessed by having an expert panel sitting alongside me. The way we're going to run the session is just a series of questions like the previous panel sessions that we've seen, and as Mark said, we're encouraging questions from the audience to come through. And we're looking to do a bit more of a deep dive into some of those technology questions that came up in the last panel. Before we start, I'm going to do a quick introduction of the panel that we have, and also lay down some context of some of the areas that we're going to be touching upon. To my left, Bernard Del Rey. We heard from him in his 5-minute spotlight just before. He's whet the appetite, and I've asked him to delve a little more deeply into the true profile solution that they've got on offer. I won't go through his bio, it's in the material, as you heard that before. Next to him is Binu Paul. Many of you will know Binu. He's been in the industry for many years in the funds management and the investment management world, and in monitoring of funds. He's the managing director and the entrepreneur behind KiwiSavvy, and Savvy Kiwi, sorry. And Savvy Kiwi is a new digital solution around that space, in the modelling space, and it's an omni-channel delivery. And I'm sure that Binu's got a lot of background in how to get a FinTech startup going in this space and some of the challenges around that. Also on the panel is Rachel Paris from, Rachel Paris, partner at Bell Gully. She's been providing legal advice on a day-to-day basis to many of the wealth management companies out there, and also the FinTech startups. And really having to deal with regulation that was put in place many years ago, before some of the things that we're now able to put into market were never even thought of. And so there's quite a disconnect between the regulatory framework and what people are trying to put out in the market. So we're going to be looking to Rachel to provide some insights in some of the challenges that both the FinTechs and the wealth managers have in that space. And then last but not least is Teresa Walker on the end there, who is the Director of Client Engagement for Calastone in Australia and New Zealand. Teresa has over 30 years in financial services. She wears that a lot better than I do. And has worked in many countries, US, UK and Australia. And with Calastone, she's got great financial experience in the funds management space, in trying to connect up legacy platforms with modern technology. And we were joking about it just before, saying one of the statements that Calastone makes is that they're trying to get rid of the fax, which is still prevalent in a lot of the funds management industries, particularly Australia and in New Zealand. So if we move on, and I just give a little bit of context around we all see that? Yes, around the what we're going to talk about. This is a piece of work that's backing a white paper that I'm having in development. It's around superannuation, but it talks about the value chain. And I was looking at some of the areas that the fintechs are particularly focused on in each part of the value chain. So if we looked at superannuation, you start with the asset, and this is just one view, you start with an asset manager, you have a custodian, you have administrators that have to do the processing behind that, a platform provider or a responsible entity who has the compliance responsibility but also bundles up and packages those solutions. Then there's the distribution component, whether that's something that's done internally, externally, or direct to market or with affiliation partners. And then you've got the advice component, whether they provide no advice or whether they actually have full advice or something in between. And the customer obviously has to pay for everything that fits along that value chain. So some of the areas in the value chain that have been penetrated first are really the asset management space and the distribution space. And why is that the case? The case is that's where there's a lot of revenue to be made, and it's where there's probably the least complexity of regulation. We haven't yet seen, and we heard earlier from Bernard, that nobody's filling that space of completely disrupting the whole value chain in this wealth management space. And maybe it's because of that level of complexity that we haven't seen that. But in the asset management space, Robo Advice, and hopefully Bernard will give us some views on what's going on in the American market around that, stealing away some of the funds from the investment managers. In the custody space, there's a lot of conversation going on around the blockchain and whether the blockchain is going to remove the need to have those trusted entities in the middle. And we'll probably do a bit of a poll a bit later on if people want us to delve a bit more deeply into what actually is the blockchain. I know you've probably been blockchained out if you've attended any conferences recently. In the admin space and platform space, it's about automation. It's about that robotic processes. It's about workflows. And it's about using the data that you have in those systems to try and streamline it so that you're only managing by exception, which brings down your cost of running the business. And aligned to that is RegTech, which is the latest tech jargon that's come out. And that's around using that big data and that predictive data to try and pick up risks in your business and monitor those processes in real time to pick up those compliance issues early on. And for me, one of the most fascinating ones, and Sally Loam was talking about it before, those new startup superannuation funds, they're heavily investing in using social networks in actually distributing their products. And we'll have a question a bit later on in the session around whether we're going to see some of those big powerhouses like Google and others picking up that space in the value chain. And then finally, there's the Robo Advice craze that's hitting the world in different ways for the advisors. And once again, we'll try and dive a little bit more deeply into that. If you looked at the life insurance space, slightly more complex value chain, and it actually is typically a loop rather than a chain. It's got reinsurers in there. But on top of those existing ones that we've already spoken about, there's a lot of work on the telemetrics, the biometrics, integrating that in with Internet of Things into the way in which insurance is delivered to people. And in particular, the use of big data and analytics, intelligent analytics in both the underwriting phase up front and also in the claims management phase. And we're seeing a lot of work in general insurance, but the life insurance industry is now fast catching up. So hopefully that's a little bit of context behind what we're going to be talking about today. And now I'll move on to a number of the questions. The first one is I'll throw to Binu, and that's really about, in FinTech today, we've seen historically them focused on areas like peer-to-peer lending, payments, etc., and in the banking space. What's led to the explosion, if you like, in FinTech and InsurTech now? Is it a technology thing? Is it a hardware, software thing? And who are the biggest influences in that space?
Yeah, surprisingly, FinTech has a very, very long history. So if you think back, the mid-1960s is when we had the first ATM machines getting rolled out. That was 50 years ago. Now, if you think about it, the initial version of the ATM was simply a cash vending machine, and it was in response to a very simple customer pain point, which was, how do I access my money when I want to access it, rather than waiting for the bank to be open or the bank tell it to be available for me to access the money. But it took nearly 10 or 15 years for that technology to go around the globe. And the reason was we didn't have the ability to actually talk to different systems across the globe. So a simple example being an ATM machine required a hardwired telephone cable to go to the back of the machine. So you're constrained by the proximity you needed to the bank branch. Digital telephony came along in the mid-'80s, and suddenly that changed the whole thing, and that's how ATM kind of started picked up. But underlying that was the advancement in telecommunication technology. So there's really three trends that I can think about, which we can relate to everything that's going on now, and it all happened in the 70s, 80s, and the 90s. The FPOS payment technology got rolled out in the mid-'80s. That was, again, the next step up. And then eventually this went on to popularizing the internet in the early 2000s, late 90s. Then we started getting into mobile technology and satellite communication and wireless and all the rest of it. The second trend that happened in the 80s and 90s was around semiconductor technology. So it impacted on a whole heap of things, but probably the two specific areas I can think of is data and memory storage capacity, and the second is computing power. So just to give you a bit of a context, the iPhone 6, and I'm sure a lot of you have heard this example, but the iPhone 6 actually can process transactions 120 million times faster than the supercomputer on the first moon shuttle. And each supercomputer costs $3.5 million US. So what's happened over this 20, 30-year period of time is that not only has our computing power gone up, our storage capacity gone up, but it's dirt cheap as well. Meaning innovation is now more commercially viable. So that's the second thing. The third thing that happened, probably not so much in the 90s, but in the early 2000s, is technology called Web 2.0. And just very quickly, when the internet first got rolled out in the early 90s, mid-90s to the general public, it started off in the US military. But when it first started off, it was a static web, which is called Web 1.0. What that meant is I could upload some content on the website, and one of you could actually go there, read it, review it, analyze it, but you couldn't do anything with it. So Web 2.0 came in, and they allowed people to interact with content that's on the website. So every single social media app today survives because of Web 2.0. So if you didn't have Web 2.0, we don't have any Facebook, we don't have none of these, right? And so what it did was allowed people to interact, allowed people to collaborate, and that allowed communities to come together on specific interest areas, and hence why we've got all these communities now popping up. So these are the three kind of mega trends that happen in terms of technology. But I think fintech specifically, the GFC was the tipping point, because that's probably the time when the large financial services incumbents kind of went through a period of challenge around mistrust from consumers and all the rest of it. But if you think about it, for the innovator, you had the technology capability now to build a solution to that particular pain point. So that's probably the four things coming together.
Excellent. Bernard, you gave us the 5-minute taster of your true profile business and the modelling that sits behind that. Can you give us a deeper dive? And I'm particularly interested in the use of, and their terms like machine learning and artificial intelligence, maybe give the audience a little bit more understanding of what that means, linked to big data, and how that's being used for client engagement, particularly in the US.
Okay, that's a good one. I guess first just some foundational thoughts. When I think of data that can be collected on a consumer, there's two types of data. One I would call, and not I would call, but the industry would call naturally occurring data. So data that I can extract just from you living your life, right? So there's going to be data that's coming off of your phone, which, by the way, I think we all know how much we actually allow each of these apps to extract. And then there's other types of data. That type of data is obviously very noisy, and it's very difficult to understand exactly what's happening sometimes. The bigger questions, not where did I travel or when did my run start and when did it end, but more importantly, like, how was I feeling this morning? Am I feeling good or am I not feeling good? The other type of data is what I would call experimental data. And experimental data is a highly controlled task that you give someone to do where you control the environment, almost like putting a plane inside of a wind tunnel. And what I would say is that we're at the stage where the industry is thinking about how do we balance both of these things, because they've found that naturally occurring data alone is very noisy, very difficult to sift through, and many times it leads to communications that just annoy clients versus actually engage clients in the right way. So I think part of this is about how do you combine experimental data, and I would classify some of the solutions that I was talking about earlier around profiling consumers as experimental data. I'm going to give you as a consumer a very well-defined task, and therefore I can control the inputs, and I can control the scenarios that you're going to face, and then I can understand more about the data that you've given me because it's been this controlled environment. So combining experimental data and naturally occurring data, I think, is one of the next frontiers, and it's definitely happening. There's some really interesting papers that are being published, and I think what is challenging as a former financial services insider is that, you know, the frontiers on this space are just not happening inside of financial services, right? There's so much challenge and complexity going on, just keeping the lights on, keeping the business profitable, keeping shareholders, that the innovation is actually not within our companies themselves, despite the fact that we're creating innovation labs and things such as that. So you know, every organization, I think, has to have a conscious effort of really looking deeply outside into academia and other things to extract those types of learnings, but they're happening.
Thank you. Teresa, that's a good segue to you. Calastone have done a survey recently of your clients and prospects, looking at some of the challenges that they have in integrating the old legacy technologies with the modern technologies. What are some of the key learnings that you've got out of that work?
Well, before maybe I go on to that, just talking about some things that we see from our perspective at the heart of the funds industry. We sit in the middle dealing with registries and fund managers on the one side and platforms and custodians on the other side. And that gives us a really great vantage point to see how technology is being embraced and how much efficiency there is today. And what we see is there's a long way to go. And it's very real. I know we were joking about eliminating the facts. You know, we can have a mission to be friction-free in our industry, but the truth is there's a long way to go. The survey that we did was around how do firms embrace technology and maybe how to think differently and take technology into the heart of their business by appointing career technologists into senior roles. It's still pretty rare to find technologists sitting on a board. There are none in Australia and none in New Zealand. There's only a small number in the UK, for example. So there is a long way to go to embrace that art, as it's the topic, the art of the possible. We need to have different, diverse ways of thinking. And we need to take people who do think differently. And all too often, what we see is a desire to digitize the existing process rather than to think differently. And there's a real example, I definitely won't name names, but a big financial services group in Australia who are looking to evolve from their use of fax for fund trades to email. And when I was talking to them about the challenge of rekeying, because there's still rekeying involved with the email, they're saying they're looking at robotics to rekey. And it sort of feels like it's missing the point. I mean, it's, you know, to the phrase that is it real innovation taking place? I think we need to think differently, think completely differently, and we need different people to help us think differently.
I suppose, so legacy technology seems to be one thing, and it's a fixation on the way in which the current process is run is one problem. The regulatory framework and the role of the regulator and the legislation that's in place is probably another thing that seems to be inhibiting particularly the mass disruption in this sector. Rachel, how is the New Zealand regulatory environment placed for fintech? What are the challenges that they need to take into account when they're thinking about this?
Certainly, New Zealand has a pretty decent starting point, in that, you know, our regulation is straightforward. It's relatively light compared to other jurisdictions. So, for instance, if you're a New Zealand startup, you don't need a license to deal in e-money or to lend to consumers or to provide financial advice, at least at the moment, around simple products. So, you know, good starting point. And obviously we were pioneers with the regulation around peer-to-peer lending and crowdfunding. But I think we're seeing other countries sort of accelerating past us, and we've stalled a bit of our activity. So I guess what are the reasons for that? And I would, I guess, look at it as macro reasons and micro reasons. So it's a slide up there which is probably impossibly small for you all to read. But in terms of macro, I think really the fundamental shortcoming and the one reason New Zealand's not hitting its straps in fintech is, a lack of genuine policy commitment to making fintech a priority. We've got the FMA trying really hard to do its bit with, the consultation they're doing around Robo Advice, but you're just not seeing a coherent policy framework. Whereas if you look at, the UK, Australia, Hong Kong, Singapore, Canada, Japan, India, the list goes on. They've really made it a policy priority, and they're putting resource into it. And they're balancing consumer protection with the desire to innovate in this area and energise the economy more broadly. So I think that is an obvious issue. And then while other countries that do have licensing regimes are sort of neutralising those requirements for fintechs with their regulatory sandboxes, New Zealand's almost going in the other direction, looking at introducing more licensing. If you look at our program of harmonisation with Australia, the pressure to adopt some of the IMF recommendations. So, I fear that maybe we're not just, inert, but potentially heading in the wrong direction there. And then on a micro level, as a lawyer, I have the fun task of trying to apply technology-neutral laws to some of these fintech products. And the technology-neutral laws I'm thinking of are, anti-money laundering, consumer protection laws and responsible lending, electronic transactions. They're just three sort of obvious examples. And the thinking there is you don't want the law to become obsolete or out of date because it's focused on specific technology. So you sort of make it very principles-based. And, it's really hard to argue with that. It prevents regulatory arbitrage. But the problem is if you're a fintech operating, a new product or service, trying to apply a principles-based legal framework, it is incredibly difficult to get any compliance certainty. So if you're a startup or even an incumbent trying to be more innovative, you've suddenly got all this compliance and legal risk on your list of other risks that any startup's got. So it again makes it, difficult for people to get comfortable taking that next step. So I don't think these are insurmountable problems by any stretch. I think they can be really easily resolved, but I do think New Zealand needs to really focus and decide, is fintech something we want to do properly?
Can I comment on?
Sure.
Yeah, so I think that's, all of those things are very true, and I would add one, which I think became apparent as I moved from New York to New Zealand, and that's there's not a lot of capital in New Zealand, which is, if you're someone who started a couple of businesses, it actually takes capital, and it's not $100 any longer. It's millions of dollars to develop an enterprise quality product that can serve consumers. It's this idea that it can just be done on the back of an envelope is incorrect, because you normally don't get it right the first time. It takes a high degree of testing. The technology is constantly evolving. Some attorneys have startup rates, some don't, right? So there's,
exactly.
There's just tons of cost in the system, and people need to eat. So there's this real kind of tension, I think, for New Zealand, which is innovation is, very difficult. If we did not have capital sources outside of New Zealand, there'd be no way possible our business would have started in New Zealand. And so I think I think there's a lot of challenges that are present, and New Zealand is doing a great job, I think, with Callahan and others. However, it's a fraction of what other markets are doing. I'll give you one simple example. We've received more money as a company from the Monetary Authority of Singapore than we have from New Zealand, and I'm not looking for handouts, but just in the, and you look at Australians' grant programs for financial services companies or any innovation, they far exceed what New Zealand does, even on a per capita or GDP basis. So I think it's really difficult to, as of now, I would say New Zealand will be a laggard and a follower, and they'll be lucky to take the technology that other markets create if nothing changes. Sorry to be so dramatic.
So just picking up on that, we've got legacy technology, we've got regulation, we've got funding and structural issues in doing something different. Teresa, you spoke at a conference recently about imagining the future and in the art of the possible theme. What were some of the things that you learned from looking at other industries around this?
It's sort of try to refocus, as I was saying before, and to look in a completely different way. We can look out into the wider world and see what's happening in for example, in healthcare, where doctors, you might be in hospital seeing a multitude of different healthcare professionals. All the records are linked up, so everyone has access to the latest report on you. You have, it's quite interesting what Volvo are doing, and the promise that Volvo have made that by 2020 no one will die or be seriously injured in one of their cars, and how they're embracing technology to make that happen. And whether that is adaptive cruise control or whether it is auto lane keeping assist, these are forms of technology that can run in the background even when the human is in control. And so that sort of coming together of the human and technology, I think, is really interesting. And I do think that some of the P2P and crowdfunding sites are very engaging, and I think there's a lot that mainstream financial services can learn from them about how to get consumers more engaged, how to use, for example, animation and gamification to get difficult concepts across. And so I was imagining a world where saving and investing is as easy as spending, and how consumers are engaged because they have this range of tools and they have a ability to interact with organizations flexibly and to change their mind about how they want to interact. I don't think it's robo or face-to-face. I think there's a continuum of embracing of technology, and I don't think it is particular to millennials. I think we all like to go and do research ourselves and feel informed before we go and take advice. And I think so I think it's just a dynamic amongst all of us. And I was imagining a world where there's a financial angel who watches over us. Many of us, most of us, will use Siri and similar technologies. Imagine if that financial angel was prompting us to tell us we're going off course and that we needed to do something, or to encourage us to save more, or maybe not go out to dinner again this month and maybe put that money aside. I think there's a lot of things that can be done. All those technologies are available today. Imagine if we took some of the sort of 3D printing effect into the way we build products and made them more flexible. There was a mention of that in the last panel on life insurance, and it wasn't so cookie cutter, and let alone so black box. I mean, we certainly need to break that open and make it understandable.
Yeah, that leads me on your financial angel starts to lead down the Robo Advice. And I was interested in Binu and Bernard's perspectives on Robo Advice and the impact it's going to have and what it has had in the US. Now, there's different trends in the way people say, but the Robo Advisor phase 1 in the US was really about those basic questions, sticking you in a box, standard portfolio, get your money, streamlined process. In the UK, it almost jumped that. Nutmeg came in, made a bit of a splash, but didn't get very far. So the big institutions have moved into Robo 2, which is a lot more integrated with human advice and a lot broader than just a single portfolio. And now they're talking about Robo 3, which is all the machine learning and the stuff, I suppose, behind your behavioural models. So, in particular, what have you seen in the trends in that Robo space, and has it flowed more into a hybrid model? Is it focused on education?
Yeah. Did you
go for it?
Okay.
No.
I mean, I think when you look at the most successful models that came through those first generation robos, it's clearly Schwab Intelligent Portfolios and Vanguard's model, which would be, I would call, hybrid. There's the robo contribution, in my opinion, has been predominantly a client experience-based contribution. So they've streamlined things, they've made it simpler, and they've just made it more straightforward to actually invest your money, which I think is a great step forward. But there's no sustainable competitive advantage, in my opinion, because they don't understand the customer any better. In fact, I think in many cases they understand the customer less than the alternative, and that's problematic. So I think the next generation is where we see more intelligent solutions develop. And obviously the capital that the largest players in the world have to deploy up against that is significant. I mean, when we're out in various parts of the world, these projects have $100 million, $200 million tickets up against them. And you have some of these first generation robos that raised 500 million, 700 million, and they have 7 billion in assets or something to that effect. That sounds like a lot in a New Zealand context, but that's a small, medium-sized advisory firm in the US. So I think most of the early investors in that are going to get totally wiped out, or the later investors that are investing at these crazy valuations, and those properties will ultimately get acquired or just plateau.
Binu, do you have?
Yeah, the way I look at it, there's probably three categories of kind of incumbents or stakeholders who are going to have an impact with things like Robo Advice. So the first group are the startups who don't have a legacy. Typically in the financial services industry, it's people who've been in the industry, come out of the industry a few years, not as young as probably some of the other startup sectors. So they know how to engage with consumers, they know what the pain points are, they can come up with the right solutions. Then there's the incumbents, who are the very large incumbent financial services companies like insurance companies and banks, hell of a lot of information and data about their consumers and what they do. One cannot work without the other. So the startups actually don't have access to the consumer data. The banks don't know what to do with it. And then there's the third category, like the Amazons and the Googles, who are actually sitting on this thing already. And so in my view, the biggest benefit or the most advantage is for those non-incumbents who are big companies but are still startups, so to say, who can easily roll out, not convert themselves into a bank, but provide banking services. Because if you think about it, a bank is a bunch of services. If you dismantle it, a startup can come along with the right amount of data and the right amount of news, they can actually dismantle each part of a bank. You don't need to be a bank anymore. So I actually suspect the big guys like Amazons and Googles and Apple and all will have a natural advantage in that space.
Yeah, so that comes back to a question I was talking about earlier, which is, do you think any of those big players are going to come in and try and attack it? Is there enough money across the value chain for them to and to come in and deal with the level of complexity? Or are they going to pick off one section of it?
Exactly.
And basically wholesale, so you guys will all be wholesaling product
They
for
will
Amazon
pick
to
the
go
most profitable ones.
Yeah.
So we'll start with lending, most likely, because that's where, so payments were the first one.
Yep.
Then now it's moved on to lending. So you're just going down the balance sheet of any bank and looking at what's the most profitable, and you're just chipping away at it.
Yeah. I think one of the things that's interesting is peer-to-peer lenders are originating loans and banks are buying them, right? So
That's
they're
right.
putting them on their, the whole securitization process is just starting in a different spot. And you clearly see Amazon already beginning to do small business lending. You set up your web shop on Amazon, they see your cash flow, they know how many customers you have, they understand, your peaks and valleys, and they actually just come straight out and say, oh, I could see you need a working capital line of $10,000. Would you like it? You're underwritten.
And they've done their AML and they've done their KYC and they've already done their onboarding.
So banks as a construct existed, again, for certain reasons, which was, the financial markets were very isolated, and there wasn't a lot of international connectivity between these things, which is no longer the case. So I do think, and I think China is probably the best example of watching, financial services products being launched by non-banks through those types of kind of communication platforms. So I think the unbundling will continue for sure.
Yeah. I think of WeChat when I think about disruption. They started off as a chat service. They've got 1 billion users now, mainly in China. They do everything from you can order water, you can get your taxi. They've now got a money transfer service. They've got their own bank, and they've started a wealth fund that's got, within the first 18 months, $350 billion in it.
Right.
So you can do all of that from one app, which started as a chat app. That's true disruption to me. That's breaking the system completely from what we've got. And it happened in China, right? Because and there's potentially some cultural and some boundaries around that culture that allowed that to happen. I can't at the moment see the same thing happening externally where someone does that. I'm seeing the guys focusing very much on parts of the value chain where they make the most money, and has the least complexity, which is distribution, using the big data and the analytics, and the vast amounts of data that they've collected on all of us to do predictive work around what we want. I mean, Amazon claim that they know what if you use Amazon, they claim they know what you're going to buy next based on your previous history. And they used to deliver it to the house, but they found that was a bit creepy, so they now just deliver it to the nearest distribution outlets. So we've got to start to get that way, I think, with our customer base, and it's using the behavioural data and understanding broader data. But then that leads me to a question around, in Europe, and in the UK in particular at the moment, there's a lot of noise around the data protection legislation. So Rachel, are we going to see a clash there again with privacy and data?
Yeah, look, that I think is exactly where New Zealand's heading in terms of opening up the very rich data reservoirs that the banks and insurers are sitting on to, the startups you see in Europe, the UK, Australia. It's actually a competition or antitrust issue. They've said it's non-competitive for these incumbents to sit on this data, which is really the lifeblood of these fintechs. So you have to build APIs and start sharing it with any third party that wants access to it. So predictably, the counter-arguments are, well, how can we, the banks and insurers that have invested in these customer relationships, open up this data to you without any compensation? How can we be comfortable about the security of that data, cyber risk, privacy? So these are all really important live issues that are being debated by regulators around the world. So far, New Zealand hasn't, had any official or formal process around it, but it will come. There's no question. So I think if you talk to the banks here in New Zealand, they know it's coming. But probably, want to start controlling the conversation in a way and start contributing to it to make sure we end up with a sensible framework, because it's going to be expensive to develop the APIs, and I guess someone's got to pay for it. So, yeah.
Just to give a bit of background on that, so the PSD2, which is the Payment Services Directive 2, is a very EU-specific legislation, and all EU banks have to comply with it by June of next year. So it's very likely none of them are going to hit that deadline, simply because of all the IT requirements.
Exactly. And, let's face it, they haven't got any strong commercial incentive to speed things up. But picking up on this issue of data and, the importance of it to fintech, when you think about these companies, they are simply data companies. And there is a local entrepreneur called Ben Lynch, who I'm sure most of you have heard of, who's developed Jude, which is his bespoke sort of personal banker, which is exactly the financial angel offering that Teresa was talking about. And it sort of works like Alexa or, one of these voice-activated sort of AI systems where you have one interface, which is Jude, and then Jude can hook into your bank account and your KiwiSaver and sort of manage your finances for you. And the reason why Jude is not scaling is access to data. And, this is a recurring theme. So I think, as Bernard said, there's capital access issues, but I think definitely the data barrier is a key one for a lot of our local startups.
And that leads me into another question around with the open API standards. I haven't seen over here, and maybe I've missed it, aggregation-style services rise up. So you've seen them in other countries, and they haven't really progressed very far. Yodlee's a good example of that, Mint, Money Hub, where they try and aggregate all of your financial position together, and then they tag on advice and tag on other services, and they become a bolt-on of other fintechs. And it hasn't really progressed because the connectivity has been clunky, and getting access to the information from banks about the main part of your wealth in the banking system hasn't been there. Do you think with this opening up of the APIs that aggregators will rise up and will start to challenge traditional wealth managers because of that more customer-centric solution that they can offer?
I guess from my perspective, the reason those products or services have worked so well, say in the UK or overseas, is because people are really disillusioned with their banks. People here might not love their banks, but they certainly don't have the antipathy towards them in New Zealand that I think they do in other markets. So as a result, you haven't seen that exodus away from sort of the consumer bank relationship to these aggregators. I mean, I'm sure it will happen because especially I think the risks are around Amazon, Facebook, Google, the sort of strong consumer brands that want to own that customer relationship plumb in the banks and the insurers, as we were discussing before. But I think New Zealand will be a little slower to get on the international bandwagon.
Yeah, just my observation on that, I mean, I kind of take my annual sabbatical to the Valley every year, and just to keep tabs on what's going on. One thing I realize is that the trust in banks in Australia and New Zealand is far greater than what you find in Europe and US, simply because the 4 banks here, predominantly large 4 banks, were the strongest through the GFC. And it's had not too many scandals still around 4 months ago. So in that sense, it's, it's one of those areas where people still continue to have that little bit of trust. Very different in the US. So.
Sorry. In the UK, I've certainly been observing the same thing with the banks. And the banks didn't even get into platforms over there. They completely missed the boat on investment platforms. It's been a fascinating thing to watch. But the other piece around that is that they're now turning to the employer, the workplace, as the trusted source. And so people are now setting up workplace schemes, and they're bolting in solutions and using the employer as the trusted relationship to gather further information. There's a group called RunPath that have hooked up with Mercer up there. And when you join the Mercer workplace solution, you get a RunPath ID, and you can take a photo of your utilities bill, and it sends it off to RunPath, who do a compare the market, come back and say, you could save £50 a year or £100 a year if you change energy providers. If you press the button, I'll do that for you, and we'll redirect that into an ISA savings account in your Mercer workplace scheme, and here's the projection of what that will add up to in the next 10, 15 years. And then they're sharing that aggregated data back to Mercer, who are using it with analytics to try and get behavioural analysis around retention of those underlying members in the funds. So there's some clever things that are starting to bolt together in the UK, but it's all around that same thing we spoke about earlier, the trusted entity in the whole piece is very important. You touched on another thing, which was around Alexa and chatbots. And we've seen it quite a bit up in the UK because Alexa has been around, and Google Home's now out down here, but we haven't really seen Alexa and Amazon down here. But it is a big craze, and NAB are talking about laying off lots of staff in Australia and basically using it as one of their primary sources of customer service. Do you see that as a key area in the next 12 to 18 months that companies should be focusing on? Or is it way up on the hype cycle?
I have a few Alexas in my home, and I can tell you that she's very helpful, and that I would be happy to have her say, Alexa, please move money between this, or Alexa, what are the fixing rates today? Okay, do that, Alexa. I mean, that's coming. There's definitely some Swiss banks that have been working with Amazon on this, and I think there's voice is the most natural communication, medium that we have. And so now, obviously, we need everyone to have these devices, and Amazon obviously is going to consider banks just like one of their merchants, and banks will be on the Alexa platform, and they will process transactions for you if you were a bank, and take whatever price they dictate because they're Amazon. So I do think that's very real.
Same sentiments, yeah.
Yeah, I'd agree. And I think for those transactional related items or flat information, I think the challenge always comes with something that requires some sort of analysis or a range of options and understanding each one.
Yeah. On that point, do you mind if
Sure.
I think that one of the things that financial services has yet been able to tackle, but I think we're 18 months from it, is this idea of almost dynamically optimizing someone's financial life. So looking at their goals, looking at their constraints, and looking at their preferences, and being able to, dynamically tell you how to balance that equation. And I think it's important that it is a three-legged stool between goals, preferences, and constraints. But the technology and the computing power is almost there, where if I know what your risk attitudes are, and I know what the risks are that you're willing to take, and I know what your true priorities are, and I know what your constraints are, that I can serve up, valid advice that's unique for you in the moment. And I think, I don't know, will Alexa deliver that to me? Probably my kids trust Alexa. They probably talk to Alexa more than they talk to me. So they probably would trust Alexa for that.
Now, I'm conscious we haven't had any questions from the audience. If there are any questions, please text those through. We've got just over 3 minutes left. What we thought we'd do is a quick thumbs up, thumbs down exercise where I'll throw a quick question out. We'll say, yes, we think this is going to work, or no, we don't think it'll work, and maybe 1 or 2 words about how long till it's mainstream adopted versus why you don't think it'll work.
That's going to be tough, Darren.
Sorry?
That's going to be tough.
Yeah, I know. So the first one of those is, I think we've already asked the question, will we see Facebook, Google and others cause major disruption, holistic disruption and, in this space? Will there be an Uber of financial services? So, all right, and when?
I'd probably say next to 5 to 7 years.
Yeah, I think it'll happen within 3 years in China. There'll be multiple players in China that are doing this.
I reckon more 3 to 5, probably.
Yeah, I think it will grow though. And to your point about holistic, I think it will grow in one space and then just grow out and out and out from that.
Thank you. The next one is, will we see blockchain and smart contracts replacing existing wealth management platforms?
Yeah, not completely replacing, but definitely putting a big dent.
Sorry, go for it.
No, you please.
So I think the smart contracts area is, but not in any other part. I think smart contracts is the only area it's going to disrupt.
Yeah, I think both smart contracts and if anyone's ever closed on a house in the U.S., you know that blockchain's going to be the winner on that one because it's just so painful.
Yeah.
But I also think that there's tremendous amount of opportunity in just the fundamental workings of banks and blockchain will. I can log on a website and pass a secure token. Why can't I pass a secure token between banks and a new frictionless platform? I think that's coming. It's here.
Teresa, you had the thumbs down there.
I had a variable.
Oh.
I think it's not yet known how it will disrupt. I think it has the potential to disrupt enormously. I think it's yet to be seen exactly how that's going to play out. There's some areas that are obvious, and you can see those as more likely, but I think we don't yet know.
Will AI and big data, particularly linked with robotic processes, put us all out of jobs?
Definitely the lawyers. So they won't take you out for lunch, guys.
Yeah, so I'm a no. I think it will just mean that we're going to do different things.
I'm going to be controversial in that I think it's going to dramatically reduce compensation within financial services, and the amount of pay that we all made in the good old days for working at banks because we thought we were smarter than everyone else is going to entirely be arbitraged away. Sorry.
Now, being an actuary and a data scientist, will data scientists be essential in wealth management businesses going forward?
Yeah.
I think thumbs high. Are we going to see the Internet of Things, telemetrics and biometrics transform health and life insurance? And is it happening now, or is it going to take a little while?
Happening now. Yep.
Will advisors be replaced by robots?
No.
That's all back to the face-to-face.
They're going to become life coaches, they're actually not going to deliver
Well,
any
yeah.
content of.
My view is if you're a transactional advisor today, you'll be replaced. If you're a relationship advisor, you'll still be around.
Right. I definitely see the day of, personal trainer meets financial advisor in a kind of comprehensive health and wellness way.
I do think they'll deliver some of their service using technology, though, and I think that some of what they do may be what we think of as robo. So I think it will be much more a blurring of the lines.
Our clock has just gone back up again.
Nice.
What was that? Thank you. Thanks, Mark. Will platforms and life insurers need to operate with cryptocurrencies?
I'm not qualified.
Yeah, I'm a believer in cryptocurrencies, I think so. Not that they'll have the option for fiat, but I think they'll use them.
And how long will it become before it becomes a mainstream accepted?
I think sooner than people realise. I think Bitcoin has a really bad reputation, but there is a tipping point. It's moving much more into mainstream. I don't know if any of you were at the blockchain conference at the beginning of the year, but I was sitting next to a builder from Tekapuna who just bought his first house with Bitcoin from margin trading cryptocurrency, living in Tekapuna. And there's this entire sort of parallel financial system that people of my age and stage just, aren't even really aware of. So I think now that I understand a bit more about it, it's a compelling proposition.
Yeah, I mean, when my nephew, who works in a construction site, was telling me about his Bitcoin account and his investment in Bitcoin, I said, oh, okay.
What's with construction and Bitcoin? There's something going on here.
Yeah.
If we can just wrap up the session and come back to reality, if you had to choose 2 technologies or fintech streams to concentrate on in the next 12 months, what would it be?
As an investor?
If you were the audience, basically, if you're a life insurer or you're a wealth manager or you're a super fund or a KiwiSaver provider.
I think I would have to give the answer that fits the business I'm in, which is it's going to depend upon your goals, priorities, preferences, and constraints.
I forgot to be specific. It was about whether you want to eat the dolphin or not.
Okay,
Yeah.
exactly. I think that's a tough one. I think it's unique for everyone.
I think I take it from a technology perspective. I think there's really 2 things that are going to be quite dramatic. One is going to be advances we make in cognitive computing, which is where the next step up from AI and all the rest of it. And the second one would be the Internet of Things. I think these are the 2 things that's going to most significantly impact on us.
I will actually have 2 different things from Binu. I think blockchain, simply just its potential application in financial services, wealth management, and insurance, and also AI and machine learning as a combo as well, just with all the data that's proliferated.
I'm going to have a bit of a reality check and say I think we need to get the fundamentals right first and to get businesses more efficient and doing the basics in an efficient way, and give us the platform to then grow and work in a different way. So I think it's about efficiency. No specific technologies, efficiency and then engagement. Would there be the 2 themes that I think are the 2 most important? I think that if I look at, we've been meeting with clients this week while we've been in New Zealand, and they've been telling us how long it takes to do something simple like process a fund trade, and how the investor has no visibility of what's happened to their money for several days. That's just basic, and I think investors are rightly so intolerant to that. They are intolerant to inefficiency, particularly on routine matters. So I think we've got to get the basics right. I think that for me would be number 1, and then secondly, improve engagement.
Yeah, and I think from my perspective, the thing we notice the most is about preparing yourself to utilise the fintechs, and that means creating an environment that allows you to consume and send out your information in a secure way to take advantage of the fintech. So don't be frightened of them. You should be looking at them sensibly, partnering with the right ones for your business. But to do that, you need to get your underlying platform right. And things like the API banking standards are going to force people out of those legacy technologies and also out of the protectionist approach that most companies have of holding everything close to themselves. They're going to need to actually be part of that community. Otherwise, they'll fall well behind the competitors. And the new fintech startups will come in, and I'm not sure that they're going to disrupt the whole value chain. They're not going to be able to come in and do every component of it, but they'll certainly pick off the biggest value components in your value chain. So be very careful of any areas that you see gaps, friction. I often talk about fintechs as being like water. If you've got a crack or a gap in your offering, they'll go straight into it. If you've got a boulder that's friction, they'll go around it. But if you've got deep pools of profit, that's certainly where they're going to go and lay. Anyway, the clock is now flashing red, which I think means we've finished the session. Hopefully you've found it useful. Please put your hands together and thank the panel for their contribution today.
Thank you again to Teresa, Rachel, Benu, Bernard, and to Darren. Thank you very much, guys.